right, let's get right into it. We're looking at one of the biggest puzzles on Wall Street today, and it involves two software giants, Adobe and Salesforce. Now, here's the weird part. On one hand, their financials look incredible. We're talking record numbers. But on the other hand, their stock prices, well, they're telling a completely different and frankly pretty scary story. This is what we're calling the valuation paradox, and it all boils down to the huge disruptive force of generative AI. And this chart, wow, it just lays the whole mystery bare. I mean, take a look. Since the beginning of 2021, the NASDAQ, which is full of tech stocks, has just soared up over 71%. Incredible, right? But then you look at Adobe and Salesforce. What happened there? They've been completely left in the dust, actually falling into the red. We're not talking about a little dip here. This is a massive, massive split. The market is practically screaming that something is fundamentally broken. But here's the catch. It's not their earnings. It's something else.
So, what is going on? Well, it all comes down to one thing, the market's deep down anxiety about AI. See, investors aren't looking at the amazing numbers these companies are posting right now. No, they're looking ahead and pricing in a potential existential threat. They're genuinely worried that AI could come along and just blow up the very business models that turned these companies into the giants they are today. And you know, this AI anxiety isn't just some vague feeling. It actually breaks down into two very distinct fears. For a company like Adobe, the big worry is something called displacement. The idea here is that new AI tools could just make their professional creative software, well, obsolete. And for Salesforce, the fear is seat compression. This is the risk that AI agents start automating jobs, meaning fewer humans need a software license, and that shrinks their customer base. So it's the same core threat, AI, but manifesting as two totally different nightmares. Okay, let's dig into the bear case for Adobe first. The real fear is that tools we're all hearing about, like Midjourney or Sora, are making creativity so easy that good enough is now within anyone's reach. Think about it. If a marketing manager can just type a sentence into a box and get a great image for a new campaign, do they really need to pay for a full Creative Cloud subscription for a professional designer? You can see the problem, right? For an investor, it starts to look like Adobe's massive R&D spending isn't for growth anymore, but just a cost to try and keep customers from leaving. That's a major, major red flag. Now, over at Salesforce, the risk is just pure math. Their whole business model, for years, has been built on selling seats, right? A license for every single human user. So here's the question. What happens when an AI agent can automate, let's say, 30% of what a customer support team does? Well, that could mean fewer jobs. And for Salesforce, 30% fewer humans could translate directly to 30% less revenue. The bears have a name for this: software deflation. And listen, this isn't just a threat to Salesforce. It's a potential crack in the very foundation of the whole software as a service industry. But hold on, these companies aren't just sitting around waiting for the sky to fall. No way. They are fighting back, and they've got some really ambitious strategies to try and turn this AI threat into their next massive opportunity. So let's take a look at how they're defending their turf, and we'll start with Adobe. So Adobe's big defense strategy? We can call it the workflow moat. Their whole argument is that a real professional, a real creative, needs a lot more than just a prompt that spits out a single flat image. They need control, they need editable layers, they need vectors, and they need it all seamlessly integrated into the tools they already use every day, like Photoshop and Premiere. And here's the real kicker. Their AI model, which is called Firefly, is trained on commercially safe data. For their big enterprise clients, that is a massive deal because it protects them from the huge copyright nightmares that can come with other AI models. That combination of integration and safety, that's a powerful moat. And they've got the financial firepower to really pull this off. I mean, look at what this defense is costing them. Adobe has more than doubled its R&D spending to over $4 billion. That is a ton of money. But, and this is the amazing part, their gross margins are still at a jaw-dropping 89.3%. So they are funding this massive AI war chest while still pulling in over $7 billion in net income. This isn't some desperate gamble. It's a very well-funded, highly profitable defense. Salesforce, on the other hand, is making an even more radical pivot. They're basically trying to move from selling traditional software to something you could call Agentforce. Think about it this way. Instead of selling a tool for a human to use, they want to sell the digital labor itself. So their business model changes completely. It's not about charging per person anymore. It's about charging per conversation or per successful outcome. This is a fundamental reimagining of what a software company even is. They're not just selling you the tools, they're selling you the finished product, the automated result.
And this huge strategic pivot is being backed by an absolutely stunning transformation inside the company. For years, Salesforce was all about growth at any cost. Now, they've turned into an efficiency machine. Just look at that operating margin. It has skyrocketed from the low single digits all the way to 19%. And because of that, they've become a free cash flow giant, churning out a massive $12.4 billion. That kind of financial discipline gives them all the firepower they need to invest in this Agentforce idea without risking the whole company. All right, so we've got the fear narrative from the bears and we've got the defense strategy from the bulls. But let's just push all that narrative stuff aside for a minute and look at the hard numbers. What's the reality on paper right at this very moment? Well, the financial reality is that these businesses are growing, not dying. I mean, look at this. Adobe's revenue has more than doubled since 2019, hitting nearly $24 billion. Salesforce has grown almost 3 times over, now at almost $38 billion. So remember those stock charts we saw at the beginning pointing straight down? Well, the revenue charts are pointing straight up, and that right there is the paradox in a nutshell. So you have to ask, what does the management team think? The people who actually run these companies and know them inside and out. Well, their actions are speaking way louder than their words. Just look at these capital returns. Adobe has sent nearly $11 billion back to its shareholders. Salesforce has returned almost $8 billion, and this is a big one, they just started paying a dividend for the first time in their history. These are not the moves of a management team that's scared for the future. They are aggressively buying back their own stock, which is basically them screaming at the market, "You've got it wrong. We think our stock is a fantastic deal right now." And all of this brings us to the valuation punchline. Check this out. Adobe is trading at a price-to-earnings ratio of just 17.6. Now, to put that into perspective for you, that's the kind of valuation you'd expect from a slow-growth industrial company, not a high-margin software leader. And Salesforce, at 29.5, is trading way, way below the typical SaaS average of 45. What this means is that the market has already priced in a huge amount of failure for both of these companies. The flip side? Any real sign that they're successfully making money from AI could cause these stocks to re-rate upwards and fast. So, where does that leave us? This is the final verdict. When you put everything together, you've got the market's fear, you've got the company's defense strategies, and you've got the hard financials. What are you left with? Is this a classic value trap, or could this be a once-in-a-generation buying opportunity? Okay, let's just quickly recap the whole debate. For Adobe, the bear case is that new Gen AI tools make their professional software obsolete. The bull case, though, is their workflow moat, the idea that pros will always pay for the control, integration, and legal safety that only Adobe offers. Then for Salesforce, the bears worry about software deflation as AI replaces human workers. But the bulls are betting on their big pivot to outcome pricing, where they get paid for the automated work itself. And this, right here, is the multi-billion-dollar question facing investors. Is this a value trap? A stock that looks cheap for a very good reason, because its business is actually dying. Or is it a generational opportunity? That's when a panicky market pushes a great company's stock price way below what its actual performance says it should be. So, which path are Adobe and Salesforce really on? In the end, the future for both of these companies, and maybe the entire software industry, really just hangs on the answer to one single question. Does AI become a feature that just makes existing products better and unlocks more value? Or does it become a total replacement that completely breaks the old business models? For investors, the things to watch are crystal clear. For Adobe, can Firefly actually bring in new paying customers? And for Salesforce, can their new agent revenue grow fast enough to make up for any potential losses in their old seat revenue? If these giants pull it off, then today's stock prices are going to look like a historic mistake. But if they fail, well, the SaaS era as we've known it for the last 20 years could really be over.